Hello, just two topics to discuss this morning. The first one will be on market breadth in US because there are something quite important happening on the US stock market, which remains highly speculative. So this is nothing new, but we can start seeing it again and again in market breadth indicators. Then I would like to show you the new ratings so on sectors because I upgraded my monthly rating at the start of the week, and we are seeing a lot of significant moves on sectors. So first of all, regarding US stock market indices, so this is a chart comparing the performance of the S&P 500, so which is the black line, and the other line is the Russell 2000 index. So as you can see, a very strong rating, especially in September, which was very good, very bullish for the US stock market, because the Russell 2000 is a very good, is a broad index, and is a good measure of the US market breadth. So the conclusion of this chart is that market breadth improved sharply in September. And as we saw, the market was very bullish in September, and the S&P kept rising in October and in early November. But what we are seeing since early October is a divergence between the two indices. So the Russell 2000 has not made new highs over the last month. So with the S&P 500 going higher, this is for me something really worrying, especially as the Russell 2000 declined significantly over the last few days. So this decline was before yesterday's session. So overall, I see that as a warning that the latest rally of the S&P is quite dangerous. The other thing that is quite similar is if you look at US high yields, this is a chart I showed in my morning mail this morning. So the red line is the HYG US ETF, so which is US high yield. And once again, you can see that there is a divergence. So the market is becoming a bit more bearish on high yield corporate bonds in the US, but is still very confident on US equities. So this is more or less the same story than what I told you last week about insider selling. There are some cracks in the US market, and sooner or later, I think this is not good what's happening on everywhere. Something quite interesting as well. So this is the percentage of S&P 500 stocks above their 20-day moving average, 50-day moving average, and also 200. So this is a short term, medium term, long term. So what we see on these three market breadth measures is that market breadth has strongly deteriorated since late October. The S&P is still hitting new highs, is still trading at new highs, but the percentage of stocks trading above their 200-day moving average, for example, is now at 70 compared to 75 a few weeks ago. So you can see that very easily. So market breadth is obviously deteriorating in the short term. So let me finish the overview of the S&P 500 with the technical analysis chart. So this is something very simple. So what we can see is that there has been a strong rise in straight line since mid-August. So early August was the latest short-term correction. So I think it would make sense to retrace this move. So look at Fibonacci retracements. Usually the minimum when you have a retracement is to retrace 23.6, so which would give a minimum, I say minimum downside target for the current, for a real short-term pullback at 25.55. But usually the the best targets are between 38 and 50% retracement, which would give a potential downside target 25.28 or even close to 2500, which is close to the 100 moving average, this congestion zone. So to be honest with you, I would prefer to see a deeper setback, minimum 2550 and even 2500. So last comment is about sector rotation in Europe. So a lot of move at the start of this week. What is quite interesting to see in this matrix, so here you have the leading sectors. So within these leading sectors, 3 new names: chemicals, oil and gas, and also insurance, which is improving as well. The all leading sectors are industrial, technology, auto, and basic resources. And within the new lagging sectors, 2 new lagging sectors: construction and materials, and also banks. So these 2 sectors are joining the group of lagging sectors. So overall, I think that if we start to see a correction towards the end of the year, I wouldn't say a big correction, because usually, as you know, November, December is not a very negative period for the year, but what we can start to see is more volatility, whipsaws, and we can start to see profit taking on the all leading sectors, and the market starting to reload lagging sectors. So that's more or less what we started to see over the last few days. So if we start to see this type of sector rotation, I think the risk is more on the industrial, technology, and also maybe basic resources. So these are the sectors that may start to build it up. And on the other hand, the market could start to buy a bit of healthcare, media, retail, real estate, maybe telecom, but that's not very clear. So all these lagging sectors may start to perform better relative to the market, or at least their relative performance may start to be more neutral, I would say. So I think it could be a good time to start booking some profits on overbought stocks, preferably on strength, because I mean there is no rush. Market does not turn from very bullish to bearish in just a couple of days. So don't be in a hurry, but I think the dynamic will start to change a bit. Thank you for listening. Have a nice day. Bye.